So the topic I'm covering today is bootstrapping versus venture capital. What's the right move? And for those in this community, you know that the right move is that it depends, right? It depends on your circumstances, depends on your goals. So first thing I'm gonna do is talk about bootstrapping. What is it? I'm guessing most folks watching this know what it is, but it's using your own funds. It can often be called self-funding, although I would say there's a little bit of a nuance even with self-funding and bootstrapping. But it's you maintaining complete control of your company, and it's the simplest structure. If you don't take outside debt or outside investment, you're bootstrapping. And it's how most businesses, not just tech businesses, because I'm gonna focus more on SaaS and startups and high growth, but just most businesses are started this way. Dry cleaners, bookstores, and frankly, it's how most businesses should be funded. The reason for that is that once you take on an investor, they have an expectation of a return, and they may provide a ton of value to you, advice, you may even become friends with your investor, but most investors are writing checks. With bootstrap businesses, that implies that at some point, you either have to, pull profits out of the business, or you have to sell that business for, what they call a liquidity event. You sell it for a chunk of cash, and then that would go to the founders and the investors. Bootstrapping really is the default, and frankly, I think bootstrapping should be the default. Let's talk about venture capital. Now, you probably know high level that venture capital is cash, right? It's venture cash. It's money that venture capitalists raise from wealthy individuals or institutions, and they do it to invest in specifically high risk, high growth companies. It's not considered venture capital if someone raises a fund and buys a bunch of real estate or invests in a bunch of car washes. That can still be a thing, but at that point it's usually called, real estate might be a real estate investment trust. Buying car washes or buying businesses is usually referred to as private equity, which is a less risky model. So the idea with venture capital is that it's high risk and high growth, and they want you to put the pedal to the metal and to go big or to go home. Some examples of those include Sequoia Capital, Andreessen Horowitz, Bessemer Venture Partners. Those are just three. There are literally hundreds of venture capital firms. I think I don't refer to Tiny Seed as this. Tiny Seed is the fund and accelerator that branches out of, that's formed out of MicroConf. But technically, we are a venture fund and an accelerator. But I don't call us that because we are different. We don't have that same mindset of we expect 1 in 10 companies to be $1 billion unicorn and expect the rest to fail, much like venture capital does. From an investor side, it's interesting to think about venture capital from an investor side and from the people who run the funds. Why would an investor write a check to a venture capital fund at all? Couldn't they just buy stocks and bonds? The thing is some of these wealthy individuals and a lot of these large institutions like endowments, right? An endowment is a big fund that Yale or Stanford or Harvard have. They don't want to be 100% in public stocks and bonds because the stock market is very bumpy, right? You have these huge drops, 50% drops, and they want to even that out. In addition, they have so much money to deploy, billions and billions of dollars, that they can and should diversify. Venture capital from the investor side is restricted to accredited investors. If you raise a venture fund in the US, you have to raise from wealthy individuals. Last thing I want to cover on that is how do venture capitalists make money? So they make money two ways. They make a management fee and they have carried interest, or it's also called carry. So the management fee, it varies on structure, but the standard is a 2% management fee per year based on the assets managed. Then there's carried interest or carry, and that is the profit or the gain, the net gain on the assets that you invest. So let's say you invest that $10 million that you raised into a bunch of startups. Some of them go out of business, and usually in venture, it's like 6 or 7, they expect to just go to 0, and then 2 or 3 to break even, or maybe it's a 2 or 3x return. It's a low return for them, and then they want 1 that is like the 100x return. But let's say blended across all that, you return $20 million. So what happens with that 20 is the first 10 goes back to the investors just to pay them back and make them whole. Of the second 10 million that you made across the companies, you get 20%. That's your carry or your carried interest. So you would take $2 million and then you give the 8 million remaining back to the investors. So you know what bootstrapping is, you know what venture capital is. The question is, bootstrapping versus venture capital, what's the right move? I'm actually going to add to that question. And I'm going to say there's bootstrapping. I'm going to say there's venture capital. Then there's this other kind of funding that I think loosely I'll call indie funding. And this is raising from places like Tiny Seed or angel investors who don't expect 9 of the 10 to necessarily fail. And then there's debt, right? There's revenue-based financing that is available specifically to SaaS companies. Once you hit about $15,000 a month, you have the option of pulling some revenue-based financing, which can be interesting as well. So when is bootstrapping right for you? If you want to run your company forever, or you really want to be able to decide when to sell it on your own and be in full control, then bootstrapping is what you want to do. Because if you don't want someone looking over your shoulder, asking questions, giving advice, most of the investors that I know are often they're able to help companies. There's actually a benefit beyond the money, but there of course is that risk that you might, get an investor who's a bad apple. I've been on both sides. I have bootstrapped several companies. Then I sold to a funded company. So I saw what $38 million in venture capital could buy. And now I've started Tiny Seed, where we've raised north of $31 million, under management that we can invest. So I've seen both sides of it. And I will say unequivocally that bootstrapping is harder, that raising funding makes things easier. Back in the day, I don't know, I had great little lifestyle businesses. There's no reason to raise money if you're going to build a business to a few $100,000 in revenue. I don't know of any investors who want to invest in businesses that are that small. If you want to raise venture capital, you're going to get on that track. We call it the venture track. That's if you want to go to the moon, in essence. You want to build that $1 billion unicorn or bust. When you raise money, when you raise venture, you're going to hire fast. The game is to burn money and to raise new funding every 18 months at a higher valuation. You will have a board of directors. You'll have board meetings. So this is where it gets more complicated. It can be easier because you have all this money to do stuff, but the complexity creeps in. Venture capitalists often are able to block a sale of your company, and especially at low valuation. So it's that thing of, they want you to go big. If you raise venture at a $5 or $10 million or $20 million valuation, and someone says, I want to pay you $40 million for this company, usually a venture capitalist does not want you to do that. Even though you'll have a great outcome, they don't want you to do that because they want you to go to that $1 billion valuation. In addition, venture capital funds have a 10-year duration. And so they want their companies to sell or to go public within 10 years. That's the trade-off I think about, is that I do think that raising money is easier. It's you can hire more support. You can move faster. I'll touch on indie funding, which is the in-between between bootstrapping and venture funding. This is like what Tiny Seed is. It's if you can find a group of angels who don't necessarily need that unicorn outcome and have all the expectations I just outlined. Maybe you just want to raise one round of $250,000 or $500,000 to make it easier to get to escape velocity. And then you want to become a profitable company, or you want to grow to the point where you sell for $20 million. You're going to raise a smaller amount of funding in that lower range, usually in the low 6 figures. I would say that this route of indie funding is simpler than venture capital. You're not going to have a board. You're not going to have someone breathing down your neck. And usually you don't have to give up control, because that's not what you're agreeing to do. You can run your business and pull profits out of it, which is not an option with venture funding, right? They don't want you to pull profits out. They want you to grow, and then sell or IPO. That's the third option. And that's something that I've seen emerging over the past 9 or 10 years. And I started writing some angel investment checks myself, and then realized that there were more companies than I had money to fund, is really what it became. And that was why we decided to raise that Tiny Seed fund. Lastly, there is debt. I have not done debt myself, but we have funded some companies who've done it. And I think you can borrow about 4 to 6 times your MRR, and then they take a certain percentage of your top line revenue for 2 or 3 years. And then they make back whatever it is 2 or 3 times their money, and that's it. And the nice part about that, if you decide to do it, is you don't have to give up equity. It's non-dilutive. Debt financing used to be out of the question, but specifically with SaaS, because the revenue and the growth is so predictable, about when you hit 15 grand, 20 grand a month, you can start finding some providers who can do that. If you want to learn more about designing a bootstrapped business, check out the video in the description of this video. So it's called Designing the Ideal Bootstrap Business by Jason Cohen, who was given at MicroConf several years ago. If you're ready to take the leap into building a bootstrap business, check out the playlist, Building Your First Bootstrap SaaS, the Ultimate Crash Course. And that's compiled from talks from the MicroConf stage. Thanks so much for joining me today. Really appreciate it. And with that, we're going to wrap this up.